We're still on section 9.2 QE, and we're going to continue on looking at the intended effects of QE. The second one is a depreciation of the exchange rate. The way that works is that as the central bank implements QE and replaces financial assets in financial markets with cash by buying those financial assets, then some of this cash will begin to leak overseas. It'll be looking for other assets, presumably with a better return than the return on domestic bonds. And so invariably, some of that cash will move into foreign bond markets, foreign stock markets, looking for A, other assets to buy. And there's no reason that some of the cash shouldn't naturally move overseas. And B, searching for a higher yield overseas. So that's going to lead to a big increase in the amount of money that is moving from the country implementing QE through foreign exchange markets and into other asset markets in foreign countries. That is how you then get the increase in the supply of that country's currency in the foreign exchange market. So that's going to put downward pressure on the currency. And the second effect is with QE lowering long-term interest rates, there's less incentive for foreign investors to actually buy the bonds of the country implementing QE, simply because they're paying lower interest rates. So that's going to decrease the demand for that country's currency. So in terms of QE, quick summary, we have more money flowing out of the country, less money flowing in. That's an increase in the supply of that country's currency in forex markets and a decrease in demand. You're going to get a depreciation of the exchange rate for that reason. Now, that depreciation of the exchange rate will then make exports cheaper for foreigners to buy, which will increase X, and it will mean that imports are more expensive for domestic citizens to buy, so import demand will be reduced. But the important thing to know there is that as import demand is reduced, people will probably reallocate their spending from, let's say, foreign holidays, which is an imported good, to domestic holidays, which is a type of consumption spending. So overall, we've got exports going up, imports going down, which increases NX overall. But just keep in mind, when imports fall because of the appreciation of the exchange, when imports fall because of the depreciation of the exchange rate, it's likely that domestic consumption expenditure will pick up as people transfer their spending from imported goods to the relatively cheaper domestic goods after the depreciation of the exchange rate. The next intended effect is an increase in asset prices. So the most obvious asset price that's going to increase is bonds. And whether people know it or not, so the most obvious asset price that's going to increase is bonds, government bonds. And as government bonds go up in price, corporate bonds are going to go up as well. Even if the government is buying only government bonds, that will increase the price of corporate bonds in the market as well. How does that work? Because as the government starts buying government bonds, it's going to push the yield down on those government bonds. So investors will now be looking at corporate bonds and government bonds thinking, well, with the yield on government bonds being pushed down, this higher yield on corporate bonds looks more attractive. And so more money will start moving into the corporate bond market and push those yields down as well. So from the perspective of many investors, corporate bonds and government bonds are highly substitutable assets. And so, of course, their price and therefore their yield is going to be highly correlated. So government bonds, corporate bonds, all increase in price, their yields get compressed. But as I've already mentioned in this topic, share prices are likely to increase as well. Two main reasons for that. First of all, investors that were holding bonds and sold those bonds to the central bank now have cash. They'll be looking at bond markets thinking bond prices are high over the long term. They're probably likely to revert back to the mean, back to their long-term mean value, or their maturity, their face value at maturity, if you want to think about it that way. So by buying simply more bonds during QE, you're likely to be facing longer term capital losses as bond prices come back down when QE is reversed under QT. And at the same time, the yields are very poor as well. That's the whole point of QE, is to push long-term interest rates down. So what investors will do that have sold their bonds to the central bank is, rather than looking at buying other government bonds or corporate bonds, the price of which will be high and the yield of which will be low, they're likely to start moving into the stock market. And so that is going, all of this money that was in the bond market now gets released, in a sense, by the central bank buying those bonds. What I'm trying to say is investors now have, instead of holding bonds, they're now holding cash. They move that money into the stock market, start buying shares, because the yield is more attractive in the stock market. The dividend yield is going to be more attractive temporarily, and share prices increase as well. At the same time, what we've seen around the world in recent years, in countries that have implemented large quantitative easing programs, is because short-term rates are low, but long-term rates are also low because of QE, housing prices tend to rise quite significantly, or they have risen quite significantly. Now, interest rates aren't the only cause of housing prices rising, but they're certainly a contributing factor. So QE, by lowering long-term interest rates, presumably short-term rates will be low as well, because the economy will be in an economic downturn, in a recession. So the QE will actually contribute to lower mortgage rates, for example, as a representative retail interest rate that's used to buy assets. So QE will lower those long-term interest rates, lower mortgage rates, and with lower mortgage interest rates, people will tend to buy more, and that will, borrow more, and that will increase their purchasing power when they're searching for a house, and so house prices are likely to rise. So certainly in Australia and in the US, in recent years, we've seen QE driving up bond prices, stock prices, and housing prices. The net effect of that is people feel a little bit wealthier. And the idea is that not everyone, but some people, as a result of that feeling of additional wealth through the inflation of asset prices, some people are likely to then increase their consumption spending. It's not guaranteed, but it's likely. And so the result is an increase in consumption spending. The fourth intended effect of QE is liquidity, just an increase in the liquidity in financial markets. So the central bank may buy some bonds directly off commercial banks. So banks like the ANZ, Westpac, Commonwealth Bank, National Australia Bank, those sorts of banks hold bonds. They hold them for liquidity requirements, and they also hold them so that they can trade them in their process of currency trading. That's a little bit complicated, but basically what banks tend to do is they buy and sell foreign exchange and try to make money by buying a certain currency at a low price and then, or a low exchange rate, and then selling it on at a higher exchange rate. They play that game. And when they want to hold large quantities of a foreign currency, for example, they will tend to buy bonds and hold that money in that currency in the form of the bonds, government bonds of that country. And so commercial banks like the ANZ Westpac, for example, hold a large quantity of bonds, and under QE programs, they're naturally going to sell some of those bonds to the central bank. So all of a sudden, we have our banking system who were holding bonds, selling some of those bonds. Now they've got fewer bonds, but more cash. What are they going to do with that cash? They're going to lend it on. They're going to lend it to their customers. And that may actually lead to a little bit of a compression on profit margins on loans. The profit margin being the retail interest rate minus the interest rate that the bank pays, or the average interest rate that banks pay to borrow money from other sources. So that profit margin may actually get compressed if there's a little bit more liquidity in the banking system, that is money in the banking system. So with interest rates perhaps being compressed a little bit through greater liquidity, as well as more money being available to the banks, that is really going to then be an incentive for the banks to lend more and customers to borrow more. Of course, central banks will also buy bonds off other types of investment, other types of investors. And I'm thinking hedge funds, investment funds, superannuation funds, these big fund managers that look after large amounts of money on the behalf of smaller investors. They will be holding bonds, and under the process of QE, they'll be selling their bonds to the central bank, and now all of a sudden they'll have cash. So then the question is, well, what do they do with that cash? They may choose to buy some other types of assets, or they may choose to buy some other bonds, and maybe perhaps some newly issued bonds. So the money could be in the banking system, it could be in the hands of institutional investors or even smaller investors. But either way, there will be more money in financial markets, and with more money, interest rates are likely to come down a little bit more, and there'll be a greater incentive to lend that money out. So with an increase in liquidity, think of liquidity as money, with an increase in the amount of money in financial markets, it's going to lower interest rates and provide more loanable funds for lending. And then you've got to think to yourself, well, what categories of expenditure are funded through borrowing? And it's going to be consumption spending and investment spending. So they're the two categories that are likely to go up as a result of an increase in liquidity.